Explosive end to the week and the charts are packed with opportunity. Here are 12 trading ideas across Forex, stocks, and commodities, from simple setups to advanced price action patterns. No fluff, let's get stuck in. So we're gonna start off with my trade of the week, which is gonna be on the Aussie New Zealand. And I know this isn't the most sexiest pair in the world, but the opportunity is pretty darn good. So bigger picture, starting on the weekly, just to gain some perspective, we can see that Aussie New Zealand has recently been in a bullish move. We've consolidated pretty much from 2014 to about 2025, and then we broke up and we've been rolling ever since. Now, if we look left, and I just draw a horizontal line here, you'll see that we're not really at a important level of structure. We're pretty much hovering between this previous outside return. So there's certainly room for this pair to go higher, and that perspective is important because as we dive down to the lower time frames, which in this case would be the daily, you're going to see that we have a retracement, but this retracement is only a brief period of relief of the bigger move. And what I mean by retracement for you guys that are new is that the market ebbs and flows. It has two things. It has extensions, it has retracements, and then those are followed by extensions, and that's how we get a trend. So you can see the market is booming up. We get this move right here, which is going to be a retracement, and we're expecting a continuation higher until the market tells us otherwise. And you can see we're about halfway through that potential extension, and this is where things are going to get really, really interesting. As we go down to the 4-hour time frame, look at that, I drew the box perfectly, you're going to see pretty much sideways movement. It is literally going from left to right. And when you add a previous bullish move to that, that gives us a nice little pattern we like to call a high and tight flag, or maybe if you want to be technical, a high and tight pennant pattern. But essentially, it is a brief pause, or it's looked at as a brief pause in the middle of a bullish move. Now, if you're super aggressive, you can buy this right now, anticipating that price is going to continue higher, or you can wait for confirmation. And confirmation would be this. If price action can break and close above the high trend line of this pattern, so that would give us the confirmation that we need to predict that price is likely to go higher. And if we are likely to go higher, the first stopping point is going to be right up here, our previous level of structure resistance. And if we violate that, well, there's a lot more opportunity to go all the way at that point that I showed you on the weekly chart. So a really good opportunity here. And as we spoke about in past videos, you don't have to worry about missing the first move. You don't have to fall for the FOMO. Understand that the zone of this trade is going to go from this previous level of structure to this previous level of structure right here. And as I mentioned, the market just doesn't go straight up, although we kind of did right here. But in most cases, the market just doesn't go straight up. It ebbs and flows. So each time we get one of these pullbacks, or each time we get one of these breakouts, depending on what type of trader you are, these are going to be different opportunities to involve yourself in the trade. So if you missed one, look for the next. If you missed the next, look for the one after that, and give yourself an opportunity to involve yourself in the trade smartly instead of panicking and getting in late because you fear that you missed out on the move. Next up is the euro dollar, and we have finally done it. We've been looking at a potential bat pattern on this pair for the last few weeks. And just to recap that real quick, we had our starting point down here. This would be our X leg. Our swing low to swing high was our X to A. Our pullback right here was our A to B. Our failed extension was our B to C. And our move down to our 886 is going to be our D completion. And again, I'll draw that on for you in a better way. Way off right here. There we go. Where's my tool? X to A to B, just to run through it one more time, B to C, and C to D, right? So the bat pattern has completed. This is a bullish pattern. So if you are an aggressive trader, you're looking to buy, or you should already be involved right here at the 886, looking for a little bit of relief back to the upside. If you're a more conservative trader, what you're looking for is your reason for entry within the zone. And this is important because I just got the question on YouTube last week about Akil. How can I take the RSI into account when trading patterns? Or maybe it was Akil, how do you take the RSI into account when trading patterns? I personally do not. I'm an aggressive pattern trader, so I put my limit order on the completion point and boom, when it hits it, I'm in. But If you wanted to take the RSI into account, what you would do is you would use this kill zone, right? So you would say, if price action enters this zone, then look for RSI to give me, insert whatever your rules say, and then you would look for your reason for entry after that. And the next idea on here is going to go hand in hand with that. So even if you're not a pattern trader, this is still a decent opportunity, right? The X leg of a pattern is always going to be a previous level of structure. So each time price gets down to these zones, we're going to have potential structure-based trades. And as we get down to the 4-hour chart, you're going to see that we are due for some relief. We had a very interesting day in the market, mainly driven by a very positive jobs number and a very positive revision from the previous jobs number. And we're seeing the dollar boom, right? But there are going to be periods of relief, meaning that nothing goes up forever, nothing goes down forever. So as a structure-based trader, as price action dives down into this previous level of structure, you can see the momentum start to stall a little bit, and that's normal end of the week trading. But this is where you start to look for those reversal patterns. So for momentum to slow, for you to get signals of a potential reversal, and for you look to trade it up. And real quick, this is something I loved from my day trading days. I called this an RSI swap. I absolutely love taking advantage of opportunities when the RSI went directly from an overbought to an oversold condition. So we've got that lining up for us too. Next, we're heading over to the NASDAQ, and rough day for the NASDAQ, rough day for the stock market in general. I'm going to show you the NASDAQ, but this is going to be true on the Dow. This is going to be true on the S&P. Anyway, bigger perspective. Yeah, bullish trends, just to give you an idea of what we're doing. So we have a pretty red day, as you can see, but keep in mind that this is just a pullback. And if we look at the wicks of these two candles right here, that pullback is coming into a nice little rejection zone. Now, as you go down to the daily chart and even the 4-hour, you're going to see, again, if you're looking to get involved in a pullback, this is a really deep area to get involved in. This is a very good area because it means it's cheap. It's also good because you know exactly where you're wrong at. If price action were to violate the lows of this previous outside return, right? If we're drawing this on like this would be our outside return. This would be our new structure high. So if price were to violate the lows of this outside return, that means our bullish prediction is wrong. And whenever we're wrong, we want to be out of the trade. So you're not going to have to risk too much to be wrong in this trade, which is going to give you a pretty decent risk reward, right? Something like this, even just targeting the highs and not even taking into account that you're probably targeting the extension. So the risk profile in these type of trades are going to be awesome with these deep retracements. And again, if we go down to the 4-hour, we're going to start getting more clues of that loss of momentum. So there's no signal here yet that this is likely to reverse. We're going to have to wait till next week to see that. But if you're looking to be a buyer when everyone else is panicking and selling, which is typically what we want to do, this is a good area to keep your eye on for that potential reversal. Now, on the other side, right? This can also be part of a head and shoulders, right? I showed you kind of this initial move right here. Price action came up, long extended uptrend. We retraced, we extended, we had a deep retracement. If we bounce off this level, give us a right shoulder and then break and close below this trend line right here, that is going to give us a head and shoulders pattern, which is a classic reversal pattern. And that would be a good opportunity for a short, meaning that we can look to either trade the breakout, right? If you're a breakout trader, or look for the pullback and then trade the breakout to the downside. Now, I know what you're thinking, Akil. Well, you're saying long and you're saying short. Which one do I do? Aren't those conflicting signals? And the answer is no, right? This is that predictive analysis. The thing that we're keeping an eye on right now is this level of structure. And here's the if-then syntax that I want you to work through. If this level of structure holds, meaning we don't break and close below it, then you should continue looking bullish, right? If this level of structure is violated, meaning that price action does break and close below it, then you should start looking bearish. So they're two completely separate signals, and it's all based on what the chart gives us. Now, real quick, just on the head and shoulders, even if this doesn't turn into a head and shoulders, simply if we violate this level and pull back, that's still going to give us that bearish option there. So two different opportunities here on the NASDAQ, the deep pullback for the bulls and the potential classic reversal pattern for the bears. By the way, I've got a video coming out very soon talking about how to simplify the chart. So if you're someone that is overwhelmed by these different names and different type of patterns, head and shoulders and double bottoms and flags and pennants, and you want a really simple way to look at how to trade them, make sure you keep an eye out for that video. It is done. I just haven't published it yet because I'm waiting. Pound dollar is next. We got two potential setups here. I'll give you one if price holds and one if price violates. So as you can see, we're going to see this with all of the charts, we have big red candles bombing down into previous levels of structure. These previous levels of structure are great places to look for potential counter trend trades, meaning we're looking for price action to come down into this zone. We're looking for all the sellers to get exhausted and then the buyers to get in and for us to get a little bit of relief. And in this situation, I would look for relief to come right back to our previous level of inside structure right here. And if we pass that level, our previous level of structure right there. So that's one thing if we can kind of get down there and hold this level. If we do end up violating that level, then I have a second projection as well. And for you guys that were in the live room, this is what I talk about when I say, hey, I start my day off always by measuring two levels of structure. That way I'm always kind of one step ahead of the markets, right? Markets, I don't mean it as if I know what you're gonna do, but I can always say, hey, if this level, this is the first level I'm interested in, if this is violated, then boom, I go to my plan B. But what's interesting about this second level of structure is this. We're gonna have some pretty good confluence here, right? I haven't done this in a while, but if I take the length of this move, the swing high to swing low, and I copy and paste it and drag it on to our retracement, we have a nice classic pattern formation called an AB equals CD. And basically what that means, you'll hear to it referred as equal measured move as well. But the length of the AB leg, right, from here to here, is of equal length to the CD leg, which is from here and projecting to go down here. And it's a nice harmonic move. We can also kind of tag team that with some Fibonacci. So I'll take my Fibonacci extension tool, drag it from the swing high all the way to the swing low and back up. And you can see that we have a nice 127 in that zone as well. So we have a 127 Fibonacci extension. We have the AB equals CD pattern. We have a nice even handled number, 32 flat. This would also be a decent zone to look for your buys if this first zone doesn't hold, or rather, this first zone could hold as well, and we can still kind of continue down. But if price action gets beyond this first level of structure. Speaking of structure, we've got an old school structure trade for you here on the Euro New Zealand. These are my favorite types of trades because they're simple. Price action has been a little bit bullish lately. 1, 2, 3, 4 straight days of bullism after 3 straight days of bearism. And we are coming to a previous level of structure resistance right up here. If we go down to our lower time frame, the 4 hour, right, you're going to see the start of this zone. You can see we're inching ever closer to it. We are doing so with a lot of momentum. That's why our RSI is massively overbought. Once again, this is a good place to look for relief, right? Look for price action to come up into this zone. Look for your entry reason of choice. Could be a 3-bar reversal, could be a lower low, lower close, could be a double top, what have you. And then look for price to give us a little bit of relief. And boom, as a counter trend trader, that's what you're looking for. You're not looking for a full move all the way back down. You're looking to get in. You're looking to do so with a very attractive risk reward. Again, your risk only needs to be above these highs because that's where you know you're wrong, and you can take advantage of a nice reward back down to our previous level of structure. So cool opportunity here on Euro New Zealand. Simple, straightforward. You see, it doesn't have to be fancy. Speaking of fancy, something that looks fancy but really isn't are the Fibonacci tools. And a lot of traders are intimidated by it because they're kind of weird and the whole voodoo magic stuff behind them, but they're actually pretty simple and can come in handy as far as finding levels of confluence. So Aussie dollar here, price is bombing down, right? Theme of the day. We have broken and closed beyond our previous level of structure support. So as I mentioned in the last one, I always have 2 levels drawn. Now I'm asking myself, okay, where is the next potential level of structure? And a very easy way to do this, and this is why we harp on it in the first training course where it's like mark up the charts, mark up the charts, mark up the charts, is to mark up the charts, right? So if I just take my line tool and go from swing low to swing high, right? here. I see a little bit of a retracement right there. And then I go on my way up here and I see a little retracement right here. And lo and behold, guess what? This is a previous level of structure. Well, guess what? This is also a previous level of structure. So if I'm asking myself the question, where is price likely to go next? I've got structure level A right there. And as I told you, I always draw out 2 levels. So we're going to put out structure level B right there. So structure is cool. It is the centerpiece of my trading philosophy, but I like to add confluence to it because if I were a lawyer, even if I had a really good piece of evidence, I would like to have more evidence. O.J. Simpson trial. Anyway, so what else do we have down here? Well, let's bring on that AB equals CD pattern like we did before, swing high to swing low. I'm going to copy and paste that. I'm going to drag it on to our retracement, and lo and behold, look at that. AB of CD is right there at that level. I can look left. I also have an even handled number, or look right. I'm used to looking left for structure. Look right this time. We have an even handled number in the 70 cent even level. That is a psychological number. Those things do play a role. I can also take a Fibonacci extension from that A leg to that B leg and back up. That's going to give me a 1414. And I can take a Fibonacci inversion, which is a little tricky way of doing it, from inside, from our structure high right here back to our inside structure there. See what that gives us? That's going to give me a 1618 in there. It's getting a little crowded. And let me do one more. It looks like a 618 retracement. So let's see. Let's take my Fibonacci retracement tool from the swing low all the way up to my swing high. Come on, baby. And yeah, look at that. 618 in there. So it's hard to see, but within this little cluster, we have a 1414, we have a 1618, and we have a 618. We also have an AB equals CD and an even handled number. So if you are a CTS trader, this stands for Combined Technical Score, you are adding up different points here, right? You have your minor structure right there. You have your fib confluence. You have your psychological number. You have your AB equals CD, right? I'm not drawing the whole thing out, but you guys get what I'm saying. This is called building a case for entry. If you don't know what the CTS score is, it's called Combined Technical Score. It's a way to quantify your trading. That way you make sure you're grading each of your trades the same way each time. Consistency. There is a YouTube video, many of them I did on them. I will try to share some in the cards or at the little screen below or in the description box. I'll share them somewhere so you guys can check it out and learn more about it. But needless to say, this is a level that I think price will go to, which could set up a potential trend continuation trade until we get to that level. Or this can be a level where a counter trend trader looks for exhaustion here and looks to trade it back up. Again, no such thing as bullish analysis, no such thing as bearish analysis. There is just analysis. The only difference is how do you use it, as a target for profit or a place for entry. Next up is Aussie Canada live room members. You guys know this one. We still have a pattern in progress. This is going to be a Gartley pattern. Our starting point is going to be right here. This is going to be our X leg. First thing I want to do is measure out my swing high to swing low. This is going to be my A leg. I will label these later. I then want to bring in a Fibonacci retracement from the swing high of that X to the swing low of my A and see where it comes to. It comes to the 618, which means I'm on alert for a Gartley pattern. And I want to look for a D completion at my 127 Fibonacci extension taken from the low of my A to the top of my B. And that's going to put me right up here. So all in all, I've got a pattern that looks like this, potential pattern that looks like this: X to A to B, B to C, C to D, with our zone of completion right here. And as one of our live room members mentioned, I forgot which one, so I can't give you credit, sorry. This can also be the C point of a bigger potential bat pattern, right? If we take a look at the bigger swing here, swing low to swing high would be our X to A. Our move down here would be our A to B. This move, wherever it lands, would end up being our C leg. And then if we were to move down, that would give us a D completion for a bullish bat right here. So nothing you need to worry about right now. I wouldn't even give this potential bat any space in my head, but it is kind of cool to see that during periods of consolidation, we can very easily and very quickly go from one pattern right to another pattern. So you got to be alert. Staying on the pattern theme, we're going to head over to silver. Silver was one we looked at last week. I think. And we had a potential cipher on silver. I'm going to draw this out real quick for you. Just want to double check to make sure it hit. Indeed it did. And let me get this cipher on the board for you. Now, our cipher pattern is a little bit different than the M and W patterns that I shared with you earlier, the Gart and the Bat. But we start off with the same thing, a swing low to swing high, an X to A. We then have a retracement. That's going to be our A to B. Now, the difference is instead of having a failed extension and a C leg that completes below the A leg, we actually do have an extension. So price needs to go beyond that A leg to give us a C leg. And then we're looking for one deep retracement all the way back down to this 786. And our zone of completion is between the 786 and the low of our X leg. So very, 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 very close to completing this cipher pattern. So keep an eye on this on silver. This is a bullish one, so you're looking to buy. Something very similar would be here on gold. And gold is coming down to a very interesting level, right? Gold's been kind of boring as of late, but it did get punished today with the jobs news and all the other stuff that happened in the market. And what's interesting is we're coming down to a nice little rejection level. And I wanted to show this purely because we had a conversation on Thursday in my live trading room about the importance of wicks, the importance of closes. Are only the candle close important? Are only the wicks important? And it made us think about kind of the differences between the two. And to sum it up in a very quick way, the closes are important for confirmation. So obviously you never want to trust the candle until it closes, because that tells you the full story of the session. But same thing like a violation of structure. In order to have a violation of structure, we need to see a break and a close above it to really have that proof, above it or below it, whatever direction you're looking in. The wicks, however, they show us the extremes of the move. And in stories like this, or I guess in candles like this, it tells us a nice little story, right? If we take a look at this candle, right, we know that at one point, this red candle, right, looked like this, right? Price action went down that deep, and then eventually it, let me do this correctly, started up here technically, right? Came down here, and then eventually it came back up to close right there. So what does that tell us? Well, it tells us that there were bulls lurking in this area, bulls buyers, and they rejected it. They bought it up, bought it up, bought it up, bought it up. So it tells us that this is a nice rejection level where the buyers were interested before. And because the buyers were interested in this level before, there's a good chance they would be interested in that level again. And this is why it's important, because as price action comes down into this level, we know that we are venturing into a zone where potential buyers are lurking, which means one of two things, right? If you're a seller, you probably want to start cashing out or moving stops to break even or taking partial positions, because it's going to get harder to work through this level. Or if you're a buyer, you're saying, hey, I may have some friends down here. Let me wait until the market gives me a clue that price action is likely to reverse, that other buyers are interested, and then you can look for an opportunity to trade it back up. Now, if you're new and that was confusing, don't worry, I hope it didn't scare you away. I will share a link below, and hopefully there's a card up right now of a video teaching how to read candlesticks. And also, we're doing a 2-day online workshop at the end of June where we're going to teach you all of this from the very beginning. So it's a very beginner-friendly workshop for you, where we always start with the basics of technical analysis and build from there. So if you actually want to learn this stuff, make sure you attend that workshop and make sure you watch whatever video I just linked to you. Now, we got a few more left, so hang with me. Just want to clean up some of the patterns that are still on the radar, because I know you guys love that. Oil, we've still got our Gartley pattern forming here. A lot of this should be review if you're someone that watches this video each and every week. And if you do, thank you for your support. This is going to be an X to A to B, B to C, and then a CD completion right down here at our 127. So this is going to be a potential bullish Gartley here on oil. Heading over to the Australian S&P, we have two potential patterns, one close to forming, one very, very far away, but we'll put it on your radar anyway. One is going to be a potential bat pattern. Yeah, there we go. Just eyeballing it here. We're going to look at something like this. Swing low to swing high being our X to A. First retracement down here being our A to B. This being our B to C, and our D completion right down here at the 886. Now, I know what you're saying. Akil, how come you didn't choose this as your B leg? This looks to be the deepest retracement. Well, we have to think about how these patterns form in real life. And a great way to do that is go into replay mode here on TradingView, right? So if I go into replay mode and I just look at what happened here, as I'm marking up my pattern in real life, I start to see price action kind of reverse right here, right? So this is going to be my B leg. It comes to the 50%, it doesn't come to the 618, I'm looking for a bat. It then retraces and does all the things that we expected to do before eventually breaking to the downside. There we go, breaking to the downside. Now, the question is, right? Now, it's important to remember that the C leg has to be our deepest retracement. So unless I get a retracement that surpasses the C leg, nothing should ever change with the B. So as we push down, you can see even though we put in this low right here, there's nothing that ever causes us to adjust the C. So this is going to remain the C until we get reason otherwise. So always important to remember that in pattern formations. If you get a little bit confused seeing kind of the ebbs and flows, go into replay mode and just practice how you would identify them if you were watching them in real time. Now, the other pattern that I want to put on your radar is going to be a potential butterfly pattern. I'm going to not spend a lot of time on this, but pretty much the butterfly is going to look something like this, right? It's going to be an X to A, swing high to swing low, A to B, a deep retracement right here going past our 786, a B to C down here, again, the deepest retracement after this leg, and then our D completion is going to come all the way up here. Now, this is seems a little bit crazy, right? Because you're looking for a bearish opportunity at this level, which means a sell. But you're looking for a sell after price action has made new highs in a very bullish trend. You're like, Akil, that doesn't make sense. Well, if you understand the butterfly is what I like to call an exhaustion pattern, right? So imagine if this were to complete. Price action would come all the way down from our level right here and go up, 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 up. Now, think about this from like a price action psychology perspective. If you are a buyer, right, we have probably lots of buyers buying down here because it's cheap. And then we have some more buyers up here and then some more buyers up here. And as the price gets higher, you would expect less and less buyers to be interested because it costs more, right? It's no different than going to the supermarket and you see something on sale and you're like, oh man, this is on sale. It's a great deal. I just bought a lot of them. But then as the price goes up, you're like, I'm going to buy one because I need it, but I don't need to buy 15, right? So it's the same kind of basics of supply and demand. But eventually what goes up must come down, right? So eventually the combination of less interested buyers and then buyers from different levels starting to take a little bit of profit and money off the table and needing to become sellers to do that. You add that to the fact that there are probably some sellers up here as well. It just starts to slow the momentum and then we start to see a little bit of a reversal before the market eventually continues in that way because then price got cheaper again and then buyers that wanted to buy up here are like, ooh, it's so cheap, I'm going to buy down here now, right? But anyway, the butterfly takes advantage of that. The butterfly is an exhaustion pattern saying that, hey, we've traveled a long way to break out. We've used up a lot of rocket fuel to break out from this level. The market is due for a breather. Let me catch my breath. Hopefully let us catch our profits. Yay! Before continuing it on with what it wants to do after that. So again, I really love the butterfly pattern from a trading psychology perspective. I think it does represent a kind of good feel for what the market does on a regular basis. Hope you guys enjoyed the video. Hit that like button before you go. Leave any questions or comments below and make sure you're subscribed. That way you don't miss any of the midweek videos. All right, until next time, plan your trade, trade your plan, and I wish you guys the best of luck in the markets this week.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the